All right, so get ready to unlock like a secret language, whispering within the markets.
Okay.
We're diving deep into the fascinating world of market correlations today.
All right.
Now, before you think this is just for like finance gurus and,
Right.
Wall Street insiders,
Yeah.
trust me, understanding these connections can be a game changer for anyone, even if you're just dipping your toes into the investing waters.
Absolutely.
Yeah.
Once you start noticing these correlations, you can't unsee them.
Right.
It's like suddenly understanding a hidden conversation happening just beneath the surface of the daily market news.
Exactly. Like, did you know there's like a historical link between the US dollar and gold that plays out like clockwork? And what about the Australian dollar being tied to something as specific as copper?
Yeah.
These aren't just random occurrences.
Right.
There are like fundamental reasons behind these relationships.
Absolutely.
So before we get to those like fascinating examples, let's start with the basics.
Sure.
What exactly are we talking about when we say market correlation?
Okay.
Imagine for a second that the market is like a giant dance floor.
Okay.
Right.
Right.
Some assets are like waltzing together in sync, while others are off doing their own thing.
Yeah.
Correlation helps us figure out who's dancing with whom and what kind of moves they're making.
That's a great way to visualize it.
Right.
Essentially, market correlation measures how closely the price of one asset, like a stock or a commodity, moves in relation to another.
Okay.
Are they moving in the same direction, opposite directions, or are they just doing their own thing, completely independent of each other?
And why should we care if these assets are doing like the tango or the twist?
Yeah.
What makes this knowledge so valuable?
Because these relationships, these dances, hold the key to managing risk more effectively.
Okay.
And potentially spotting those profitable opportunities that most people completely miss.
Ooh, now those are two things any investor wants to hear more about.
Right.
Less risk.
Of course.
More profits.
Yeah.
Tell me more.
Well, let's break down the different dance moves we see on this market floor.
Okay.
We measure correlation on a scale of -100% to 100%.
Okay.
A perfect positive correlation, meaning a 100%, means those two assets are practically joined at the hip.
Okay.
It's like two synchronized swimmers.
Okay.
When one goes up, the other goes up by the exact same amount.
Okay. That's crystal clear.
Yeah.
But what would that look like in the real world?
Sure.
What's an example of a 100% correlation in action?
A great example would be the FTSE 100 index and a FTSE 100 CFD.
Okay.
Because a CFD is designed to directly track the underlying market.
Right.
Their price movements are going to be virtually identical.
Okay.
It's like looking in a mirror.
Okay, so that's the always dancing together scenario.
Right.
But what happens when it's not a perfect score?
Yeah.
What if it's, say, a 50% correlation instead?
Yeah.
Do they occasionally step on each other's toes?
Exactly. With a 50% correlation, those two assets generally move in the same direction.
Okay.
But not always with the same intensity or consistency.
Right.
They might waltz together for a while.
Yeah.
Then one might decide to branch out and try a solo.
So it's like they're dance partners,
Yeah.
but maybe not like soulmates on the dance floor.
Exactly.
Got it.
Yeah.
Now, what about when the music takes a turn and we're talking about negative correlation?
Right.
What kind of moves are we looking at then?
Negative correlations.
Yeah.
That's where things get really interesting.
Okay.
Imagine two dancers moving in opposite directions.
Okay.
One stepping forward as the other steps back.
Right.
That's what happens with a negative correlation.
Okay.
When one asset rises in price, the other tends to fall.
Like oil prices and airline stocks.
Yeah.
When the cost of fuel rises.
Exactly.
Airlines like feel the squeeze.
Yeah.
And we often see their share prices dip, right?
You nailed it.
Okay.
And of course, we have those assets who are perfectly content dancing solo.
Right.
That's our zero correlation.
Yeah.
No real relationship.
Okay.
No influence on each other's moves. They might share the dance floor,
Right.
but their routines are completely independent.
So understanding these correlations is like having X-ray vision into the market's dance floor.
Yeah.
We can see which assets are connected.
Right.
And how those connections might, influence their moves.
Exactly.
But how do we actually use this knowledge to our advantage? I've hinted at managing risk
Yeah.
and uncovering like hidden opportunities.
Absolutely.
Let's break those down.
Okay.
Let's start with risk. A lot of investors, even seasoned ones,
Right.
get tripped up by assuming diversification is as simple as just buying a bunch of different assets.
Yeah.
But here's the thing.
Yeah.
If those assets are highly correlated,
Yeah.
if they're all doing the same dance moves,
Exactly.
your portfolio becomes vulnerable, one market hiccup,
Yeah.
and everything takes a hit.
Totally.
It's like putting all your eggs in seemingly different baskets.
Right.
But those baskets are all tied together with a very fragile string.
Exactly.
Okay, so understanding correlations helps us build a more resilient portfolio.
Absolutely.
One that can handle a few missteps on the dance floor.
Yeah.
What about those hidden opportunities you mentioned?
Sure.
Where do correlations come into play there?
This is where things get particularly interesting. Imagine you've been watching two stocks that typically move in lockstep.
Okay.
A strong positive correlation. Then suddenly, one of them breaks away from the pattern, starts dancing to a different tune.
Oh.
That diverges, my friend. That's where the opportunity lies.
Because it could mean something is shifting.
Right.
Something the market hasn't fully priced in yet.
Exactly.
Okay.
It could be a signal that one of those stocks is about to make a big move, up or down.
Right.
And understanding the historical correlation helps you spot that anomaly early on.
Okay.
One strategy that directly leverages this is pairs trading.
Pairs trading.
Yes.
Now that sounds intriguing.
Yeah.
I'm assuming this dance floor strategy involves, pairs.
It does. Pairs trading is all about identifying two assets with a historically strong correlation.
Okay.
And then looking for those moments when their prices diverge.
Right.
When one partner strays from the routine.
Okay.
Traders who use this strategy will often buy the underperforming asset and short sell the outperforming one.
Okay.
Betting that the correlation will eventually snap back into place.
So in a way, you're betting on the dance partners finding their way back to each other.
Precisely.
Okay.
It's not without risk,
Right.
of course,
Yeah.
but it's an excellent example of how understanding correlations can open up a whole new world of trading strategies.
Wow. Pairs trading.
Yeah.
That's a whole new level of market strategy I never even knew existed.
Right.
This deep dive is already
Yeah.
changing the way I see the markets.
It's fascinating stuff.
Speaking of scratching the surface.
Yeah.
I'm ready to dig into those real world examples you mentioned earlier.
Sure.
You piqued my curiosity with the whole US dollar and gold connection.
Right.
What's the story there?
So the US dollar and gold,
Yeah.
these two have a classic inverse relationship.
Okay.
It's almost like clockwork.
Yeah.
When the dollar strengthens, gold often weakens and vice versa.
Okay.
The reason.
Yeah.
Well, gold is priced in US dollars.
Okay. So if the dollar is stronger,
Yeah.
you can buy more gold for the same amount of money.
Exactly.
Okay.
That increased buying power can put downward pressure on gold prices.
Right.
And of course, the opposite is true as well.
Okay.
A weaker dollar often makes gold relatively more expensive,
Right.
which can drive up demand and prices.
Fascinating. So it's a constant push and pull between these two.
Exactly.
What other correlation pairs should we have on our radar?
Let's head over to the land down under.
Okay.
We often see a strong link between the Australian dollar, or AUD, USD as it's known in the currency market,
Right.
and the price of copper.
Australia and copper.
Yeah.
That feels random.
It does.
'Cause I know there has to be a reason.
There is.
Yeah.
Think about Australia's economy for a second.
Okay.
It relies heavily on exporting raw materials.
Right.
And guess what? One of their biggest exports is
Copper.
copper. There you go.
Of course. So when the global demand for copper is high,
Yeah.
Australia's economy gets a nice boost.
Yeah.
And their dollar strengthens alongside it.
You got it.
Okay.
And just like that, we see how seemingly unrelated assets, right, a currency and a metal in this case,
Right.
can have this intricate link.
Yeah.
Now, flipping the script,
Okay.
when copper prices plummet,
Yeah.
that can signal potential weakness for the Australian dollar.
Okay, so we're seeing how a country's economic engine can really drive some of these correlations.
For sure.
What other surprising examples come to mind?
Let's shift gears
Okay.
and look at USD and NOK,
Okay.
the exchange rate between the US dollar and the Norwegian krone,
Okay.
and its connection to Brent crude oil.
Norway oil.
Yeah.
Okay.
Remind me what we're looking for with the correlations again.
You want to see if there's a relationship? Do
Yeah.
they move similarly, inversely, or not at all?
Exactly. In this case, Norway is a major player in the global oil market. specifically Brent crude.
Okay.
Their currency, the crony, often strengthens when Brent crude prices rise.
No, if someone was expecting oil prices to surge
Yeah.
based on, say, geopolitical events, they might also, like, keep an eye on the Norwegian krone.
You're catching on.
Okay.
Now, let's round out our examples by coming back to something we touched on earlier. The connection between stocks and commodities.
Right, like airline and oil prices example.
Exactly.
But this time, let's go broader.
Right. Think about all the companies out there whose entire business model revolves around a specific commodity. Take, like, mining companies, for instance.
Okay.
Their fate is intrinsically tied to the prices of metals like gold.
Right. Silver. Or copper.
Okay.
Right.
So when those commodity prices are through the roof, those mining companies are, like, raking it in.
Exactly.
And their stock prices likely reflect that success.
Right.
But on the flip side, if, say, gold takes a nosedive, those same companies could be in trouble. And their stocks might follow suit.
Precisely.
Okay.
It's a great reminder that understanding these correlations isn't just about, memorizing pairs.
Right.
It's about understanding the underlying mechanisms driving those relationships.
Yeah. This has been a genuine eye-opener.
Good.
I feel like I've just been handed, like, a secret decoder ring for the financial markets.
It's a new way to see things.
And remember, everyone,
this is just the tip of the iceberg.
Absolutely.
There's a whole world of fascinating correlations out there waiting to be explored.
Exactly.
So keep an eye on those dance partners. And who knows what opportunities you might uncover.
Absolutely.
That's all the time we have for today's deep dive.
Okay.
Until next time, happy investing, everyone.